long overdue video today. This is going to be a video going over my long-term investing strategy, how it has changed over the past couple of years, what I've learned from making a lot of money, losing a lot of money, thinking I know what I'm doing, thinking I have absolutely no idea what I'm doing, all of the above. So right now we're looking at the Robinhood portfolio, which we pretty much cover every single week. I do a video, like kind of a weekly vlog almost, which is kind of like behind the scenes into what I'm doing in a given week. We cover day trading updates, training updates, I'm training for an ultra marathon, all these different things that are kind of going on behind the scenes. And they kind of all like connect in a lot of ways, whether it's consistency, discipline, all that stuff. But the point of this video is this video is going to come out a little bit after the fact, but don't worry about the timing of it. It doesn't really matter. It's going to be going over my strategy. So I'm covering up some positions, which I will get into here in just a second. But what I wanted to start off with was the portfolio as we speak is up 45% this year. That's cool. That's great. You know, past couple of years, I've had insane years. I've had terrible years. The purpose of this portfolio, and really it's something that I didn't establish until like around like the beginning of this year, has changed in a massive way. I used to be someone that would be like, I always felt like I had to have money invested, and I have money invested. Actually, I am on margin right now. So I don't want to say that I'm not feeling like that, because to a degree I am, but we'll cover the whole points and we'll cover the reasonings here in a second. The point is that this portfolio now has gone from trying to make as much money as fast as possible to falling into an actual strategy. The problem with trying to make as much money as fast as possible, it's very easy to strategy hop, to trend jump, right? And what that means is all of a sudden you're going long when everyone's going long. You're going short when everyone's going short. You're playing breakouts when everyone's playing breakouts. You're playing small caps, and you're doing all these different things. And there are people that can do very, very well. But what I have seen from my own experience through other people that I have observed and my own personal experiences, it's very difficult to go or to trade that way and to be an active trading or an active investor, if you want to call it that, because you might not be day trading, but you could be like to be an active swing trader or something like that. It's very difficult to do that long term. You could go on runs when you are aligned with the market, but I think from a trading perspective, we have to understand, like, you know, of course, the market can do whatever it wants to do. And this past year has been a hilarious example of that. Like, for example, like if you just go to look at the S&P 500, I kid you not, like, and you guys all know, this is not a, you know, a crazy thing to say. What was everyone thinking in here? That we're going to new lows. You know, no one thought we're going to keep going higher, and here we are at over 4,500 on the S&P as I'm filming this video. Maybe it's higher when you're watching it. Maybe it's lower. The point is, guess what? It doesn't matter. If you were the guys shorting all in 2022, maybe you caught on earlier, maybe you kind of had that, you did very, very well. But a lot of people who trend hopped to that all of a sudden got fucked, because now they think we're going to go to new lows. They think it's going to be a massive recession, all these different things, and they're wrong. And it's like, well, how do you, when do you stop out? When do you admit defeat? And so I have been that guy, and I have been, dialed in. All of a sudden I'm aligned and things are working. I'm aligned really well to small caps, and all of a sudden I'm really nailing the small caps, and then small caps die. And I'm not quick to recognize that. And all of a sudden you're in massive drawdown and you give it all back, right? So the point of this portfolio is to not give it all back. The point of this portfolio is to stack, compound, and steadily grow this portfolio in a manner that is actually something that I can replicate long term. The percentage gain this year, don't get fooled by that. That number is going to slow down, and maybe we'll be going red at some point. The reason why is because the market is up a lot this year. On top of that, there have been some decent positioning, macro positionings that I've had that have kind of worked. One example is silver. For example, AGQ. This position's up 38%. That's done pretty well. SOXL is, a leverage play. I added some leverage and now I'm deleveraging. I was up to a position that was maybe like a couple $1,000s. And now I've trimmed it out to where I'm only in with $500 left. And the position's up 156%, right? So you had some big wins. But now, what am I getting at here? Great, you had some big wins. I'll cover the positions in a second. But now it becomes a game of protecting those wins, right? Protecting what we have. This portfolio, the point is to slowly compound and grow it over time. And if we have some lucky plays or we get positioned in something and it does really well, we take the profits because we know that those are just little pieces, little offshoots, little fingers around the core palm of the strategy, the fist, right, of the strategy, which is dividend ETFs and just solid overall market investments. We're not trying to gamble and we're trying to build a portfolio. I am trying to build a portfolio here that can legitimately go through bull markets, bear markets, and not have me shitting my pants, selling everything, cashing out, going all in, going all out. No, like there will be a core of this that I always have a position in. And I have, there's one potential possibility I've said in the past of when I would sell everything. And that's if the S&P 500 went over 5,000 this year, I will start to trim out of even my core holdings. At that point in time, it would have done very, very well. I would be up a lot. And I would say to myself, this money, the risk reward for me no longer makes sense. Chances of that happening, pretty low, but it could happen, right? It could happen. Why not? We'll see. Likely it doesn't happen, but whatever. That's the only scenario. Blow off top type stuff. And that point, it can go to 5, it can go to 6,000, 7,000, 8,000 in the next year. And if I miss that, I missed that, right? That's an amazing move. There'll be day trades to be had there, and I'll probably partake in those. That's, who cares? So into the portfolio. What we have right now is a core of the portfolio into this bad boy. Okay, this is a income ETF it's very well diversified into a lot of different sectors, a lot of different stocks, and it's a current position that's around over $6,000. I'm dollar cost averaging into this position every single month. I'm also having my dividends reinvested into this every single month. So I believe I began the year with around 100 shares of JEPI. I'm now up to about 115 and a half shares per Robinhood, right? And that is the core, right? And so the idea here, and the dividends like up around 10, 11% per year when they pay that monthly, which is pretty cool. The plan or the key is that the game plan is this is going to cash flow me. This is going to cash flow me over time. Over time, we're going to get cash flow out of this, and we're going to build this, really nice compound interest beast that we're going to have. And the game plan is eventually to build positions out, obviously diversify a little bit more, not just into one of these, but a couple different income ETFs, and to be getting to a point where, it's cash flowing you a couple $1,000s a month, right? It's paying the rent, it's paying the car, it's paying the insurance. It starts to pay, not that I'm necessarily taking it out for those things, but it starts to get to that point where you start to free yourself and say, hey, any active income now isn't necessarily needed to cover those bills because this can. That's like the ultimate financial freedom goal that everyone kind of has, but that starts to become pretty cool, right? So that's the goal. On top of that, what else do we do? Well, we have a couple ways that we hedge. So that's like long stocks, okay? Not risky stocks, not tech, not like going into two names and saying, yeah, all in NVIDIA and AMD and here we go. No, it's not that. It's very diversified. So it's not moving a ton. The market generally goes up, it will generally go up, but the dividend is what we're getting paid every month, and that's bringing in cash flow, and that's allowing me to compound faster and faster and faster, build that snowball. Next, on top of that is we had a silver play. I wanted to get some different exposure, and so here is this. Now, I may be out of this by the time you're watching this video. I have a covered call at 33 that expires on the 21st of July. This video is going to come out just after that, so I may be out, but I still might get back into SLV. Either way, I had exposure to this. I wanted to get exposure to the precious metals, and this is one way to do it. It was a bit of a leveraged silver play, as in SLV wasn't super volatile, although it's more volatile than gold. On top of that, we have some hedges for the downside and for a recession. One of the ways we're hedging for a recession is TLTW. This gets me TLT exposure, but also pays me a monthly dividend because they're essentially selling covered calls on TLT every single month and paying investors an extra piece of dividend. So that's very, very nice. This is also a piece of the portfolio. We have TMF, which is a leveraged TLT. So we have this, and why? Because if the economy goes into recession, the Fed will have to cut rates, and so bonds will go up, yields will come down. Again, do I know that's going to happen? No, but it's an additional finger off of the core, right, off the core palm of the portfolio that covers me in case it happens. So we're covered there, right? Just from a macro view. Silver is another finger. I don't have any exposure to the metals. Let's get some. Great. Well, a little bit of silver exposure. Cool. There's also now Bitcoin exposure, BITO, Bitcoin exposure. We have exposure to Bitcoin. This is up 14% as I'm filming the video. Cool. Doesn't really matter to me. Bitcoin is very volatile, so this could be pretty volatile. They pay a dividend here as well, I believe every single month, and I sell covered calls. So that's that. Outside of that, I have SQQQ now. As I'm filming the video, I have this. I recently added to this because I wanted to get downside protection. I literally bought it today. So I wanted some downside protection when I'm going away, and also the market's very extended. So I'm like, hey, it would not surprise me here if the market pulled back. And so I only will do this in times where we are seeing the fear and greed index go into extreme greed. We see sentiment go extremely bullish, and we see the market get extremely overextended. It could keep going. I have no idea if it's going to keep going or not. Doesn't matter. It's a way to kind of hedge my backside. And if we get a nice pullback in the market, guess what? I lock in the gains here. Market can go a lot lower. Who cares? I have a couple extra bucks that I can now deploy and buy the dip or buy into that weakness later on into the dividend ETFs, right? Or hold the cash if I want to, right? So there's that. And then last but not least, I have a real estate hedge as well, which is a short real estate ETF, SRS. This is actually down as the market's gone much higher, but it's another way I'm hedging my portfolio. So you can kind of see that we are hedged and we're using different kind of macro narratives, if you will. And thinking from a macro, like economist perspective, I actually have also a degree in energy business finance, believe it or not. Meteorology and energy business finance is what my degree is technically in. So I had to take a bunch of these classes in macroeconomics. So it was a big part of it, right? So I do have an understanding of this stuff. And so from a macro view, I have to understand this, right? I might have a bias or what I think is going to happen, and that's great. So the way that I'm playing that is using the fingers of my portfolio to not go super risky and to diversify it through the macro, but have a core strategy that doesn't matter what the macro does. The core strategy of dollar cost averaging into the dividend ETF is going to build me a bigger cash flow, right? Every single month over time, it's going to build me a bigger portfolio. And it's something that as the market hopefully continues to generally go higher throughout our lifetimes, next couple decades, it should appreciate as well. So we've got high yields, appreciation, and then last but not least, covered calls. All these at the top of our screen are covered calls. So how do I make sure those macro swing investments, if you will, those macro fingers of the portfolio aren't super risky? Well, I will sell covered calls, and ideally they expire worthless, and eventually they'll expire in the money, and they'll take me out when I have really nice gains on those. And that's what I did for SOXL. SOXL, I recently got taken out into the 20s. I had been in this thing from an average of $10. I got taken out in the 20s. I let a covered call expire in the money, and it just took 100 shares from me. And it deleveraged. I locked in some nice gains, and great. So that, in a nutshell, is how we're operating the portfolio. You know, is it going to be 45% every year? No. But the intention and the idea here is that I think it's, very, very doable to do 10+% per year. And when I say 10 plus, I'm not saying 10 to infinity. I'm saying, 10 to 15 to 20, I think is very doable with some high yields, add in selling covered calls. and then a little bit of skill from the macro, or if your macro, is semi-accurate, there you go. So it allows you to kind of feed the FOMO, if you will, of like, I think this is going to happen, but doing it in a smart, safe way, but also a diversified way with hedges in place and selling covered calls. And then also the core is the core. So worst case scenario, the bond market or bond yields keep going higher. Okay, it's not like the entire portfolio gets blown up. No, a couple $100, whatever. And as of right now, of course, that could change with the sizing as time goes on. Bitcoin gets crushed. Okay, a couple $100, whatever. Right? Silver gets crushed. Okay, a couple $100, whatever. But also on those swing investments, I also will deploy stop losses. So I'm not going to get absolutely destroyed. So that's kind of how I'm playing it. I have to take myself away from the trading approach, which is separate from this, because day trades, I only have a specific setup. I play one setup, and it's either it's there or it's not, and I take it or I don't. And that's it. This is a little bit different, but that's how I'm kind of playing this portfolio. And then to wrap it up, there are times when it's, when it might be time to go a bit more into the margin or into, fully loading the cash and whatever and deploying cash. And there are times not. So for example, the portfolio has done very, very well. If I flatline the rest of the year and had a 45% year, that would be awesome, right? So at a time like this, it's not a time to deleverage out of, riskier, equity positions and whatnot. And I don't really have a lot of equity positions outside of my core. So it's a time where I'm selling SOXL. I'm selling out of those things. And now we've got extra cash. Or if I wanted to, I could deploy some of that cash into JEPI and build a bigger dividend ETF position. What I've also got right now is a hedge. So let's say the hedge does well, make $100, $200, $300, great. Sell the hedge. I now have some cash and I can go look for deals, or I can go just deploy that into JEPI, not look for deals. I can deploy that into JEPI and build that to be even bigger over time. That's where we're at. So it's taking these times where it's risk on and things are going well and understanding, great, let's preserve that through a more defensive portfolio and be smart. That's where my mind's at right now. And that's a whole portfolio update for you. So with that said, appreciate you for watching. It's probably longer than it needed to be, but hopefully they got the point across. Thanks so much, guys, and I will see you in the next one. Peace out.